I'm joined by Andrew Francis from Realindex. Good on you, Andrew. Thanks for joining us. Now, you're talking about fundamental indexing. Exciting topic. What is fundamental indexing?
Thanks, Andrew. Fundamental indexing, I guess if we start with the concept of indexing and what is that, and what are some of the benefits of that, well, there's a lot of benefits. It's lower cost, lower turnover. Indexes give you a very diversified portfolio, and it's not relying on my judgment or your judgment to pick the stocks. And so it's very rules-based. So they're the benefits of all indexes.
And there's a traditional process, isn't there? So, you know, it's not in the olden days, it's still now. What's the traditional way of doing it?
Well, the traditional way of indexing is market cap indexing. And so a market cap index measures the market's return. The market is the sum of all participants that are in the market. And so by investing in a market cap index, you will get the market's return. How that's calculated is by calculating, so the share price times the number of shares on issue, and that equals the market capitalisation of an individual company. And then say for the S&P ASX 200, it's the top 200 companies by their market cap weight. And the key there that I was talking about is its share price is determining the weight of a company in its index, in a market cap index.
Yep, and I go to my financial advisor and he says you've got to have this much in banks and this much in mining and this much in real estate, and I just follow that because that's the way it's always been done.
Well, a market cap index, price will determine those weightings. And so you think about price, the higher a company goes up by price, the more weight it'll be, all things being equal, in an index. So think about BHP in 2010 when China was stronger for longer. Its share price got up to about $50. Its weight in the market cap index was around 13 to 14%. Today, its share price has gone back to $35 and its weight in the index is around 9%. It's a little bit counterintuitive because it's putting more money in the more expensive, less in the cheaper companies. And over the long term, if you believe in long-term mean reversion, then that can cause a return drag.
Okay, so you're looking at it a different, like a newer way, which seems like everyone should have been looking at it the same way or this new way for a long, long time. Explain that for us.
So what we do is, one, I guess our starting point is that markets aren't perfectly efficient, and therefore you want to break that link with price and portfolio weight. And so what we do is create an index based on company fundamentals. So 5 years of sales, 5 years of dividends, 5 years of cash flow, and the latest book value. And so have an index that looks at the company fundamentals rather than price. And so it has the look and feel of the economy rather than the look and feel of the market.
Okay, so it shouldn't be, you're not working to a straight, algorithm or, a plan that someone else has said, this has always got to be this way. Yours is changing and constantly changing.
Well, it's changing, it's weighting by the company fundamentals, historical company fundamentals, and 5-year averages. So if you look at company fundamentals, they don't tend to change very much through time. And so if you think about BHP in that example, the fundamentals of BHP in 2010 might have meant it had a weight of 10% in 2010. So people might have looked at a fundamental index and said, you're massively underweight BHP.
Yeah.
I would look at it and say, we've still got a 10% weight in BHP. It's quite a big position.
Okay.
But yes, relative to the market cap index, we're underweight that. Today, we've got a weight of around 10.5%, whereas the market cap index is around 8.5%. So all of a sudden, we're overweight BHP. The fundamentals didn't really change that much. It's price that's moved around the fundamentals. And what we're doing is rebalancing back to those slow-moving price anchors. And by saying rebalancing, what do I mean? I mean, effectively, we're selling our winners and buying our losers.
Okay, but shouldn't we been doing that all the time anyway?
Well,
I mean, this just makes so much sense. Why hasn't that been the case?
Well, I love the way you're thinking, Andrew.
But it does make sense, doesn't it?
It
it's
is.
like get rid of the dead wood and get the good live wood going.
Totally. I mean,
so why hasn't that
because
been
it's
happening?
hard. This is contrarian investing.
Okay.
And you think about, people do it at the asset class level. So your planner might have said to you, you have a third in bonds, a third in property, and a third in shares.
Yeah.
And you know what? Once a year, we're going to rebalance back to those weights. And you go back to him and say, last year you might have said to him, in say if you were rebalancing the 1st of January, you might have said, why am I selling shares? They've done so well.
Yeah.
And why am I buying cash? It's done terribly. But that's exactly what rebalancing is doing. It's taking profit from your winners and selling your losers. So it rebalance the portfolio back to that 1/3, 1/3, 1/3. And over time, that makes money. What we're doing is that exact same concept, but in the equity market.
Okay.
And so there is no rebalancing in a market cap index. It just keeps on putting more money in the most expensive, less in the cheaper, and therefore over the long term, if there's mean reversion, then you'll have this return drag. And that's about 2% in most markets.
Okay, and 2%, which doesn't sound that much, is actually quite significant over time.
2% is massive. And I think people think 2% not much. But
Yeah.
you think of, where's inflation now, Andrew? It's about 3%.
I was going to say 3.1, but yeah, 3%.
About 2.5, 3%. Yeah,
Yeah,
somewhere around there.
Yeah.
And then if you think you have a really good year, you might get 3%, 4% better than that. So,
Yeah.
you might get 6%. Then, so, 6% is, a reasonable long-term, outcome. You think if you had 40% of your shares invested, then for 40% of your portfolio, if you can get another 2%, then that's 6.5% versus 6 of the total portfolio level. But let's think of 2%. Okay, if I said in 1962 you could have invested $10,000 in the S&P 500, compounded over the last 50 years, what do you reckon that would have been worth today?
I failed maths in Form 5. I'd say, I don't know, $1 million, I don't know, $500,000.
You did well at maths, clearly. We did talk about that, but it's 1.2 million.
Right, which is an incredible amount of money.
Isn't it? It's fantastic, and that's the power of compounding. It's an incredible amount of money until, if I said, what about if we didn't weight by prices, but we weighted by company fundamentals, and you just put it in a fundamental index? You would have had $3.6 million.
Right.
That shows you the power of compounding and an extra 2% over the really long term.
Okay, how are you going with this new idea and selling the new idea? Is it getting some good traction?
Yeah, it is, definitely. We've seen great traction from both institutional and retail investors in Australia. We started 5 years ago, so in the midst of the GFC, and straight away when we saw...
it's all up from there, so...
It is, yeah. So, I mean, it was fairly scary at the time, but as soon as we saw planners and institutional investors, they understood what we were trying to do. We're trying to capture those benefits of passive investing, still invest passively, but don't weight by price.
Okay.
And they really understood that because they've been there. They've seen the News Corp weighting at 20% in 2000. They saw the tech media and telco boom where... Did you have a Nokia phone back then?
Yeah, I did actually, yes.
Right. So do you have a Nokia phone today?
No, I don't. I don't think...
Right,
yeah.
okay. So think Nokia, if you were a Finnish investor, you would have had 80... If you were invested in the Finnish stock market, you would have had 82% of your portfolio invested in Nokia. Would you be pretty happy with that investment today?
I don't know. I actually don't... No, I don't know.
Well, think how many people have a Nokia phone.
None.
Exactly.
Next to none.
So it hasn't been a great investment.
Okay, right.
So, but, that's the sort of... I guess that's what we're trying to break.
Okay.
Putting more money in the most expensive, less in the cheaper companies.
Okay, great. Well, thanks for explaining it for us.
Yeah.
Good to meet you. Andrew
Thanks,
Francis.
Andrew. Cheers.